In this video, you will learn about the Avoidance of Double Taxation Agreements or DTAs. Singapore Company A makes an interest payment of $1,000 to non-resident Company B in respect of a loan. This interest payment is subject to withholding tax. Singapore Company A will withhold a percentage of the interest payment and pay the tax withheld to the IRAS. Non-resident Company B will then receive the net interest payment. But hold on! What if this same interest income earned by non-resident Company B is also subject to tax in its home jurisdiction? This will give rise to double taxation of the same interest income earned by non-resident Company B, once in Singapore and once in its home jurisdiction. Thankfully, Company B is a tax resident of a foreign jurisdiction which has entered into an Avoidance of Double Taxation Agreement or DTA with Singapore. Non-resident Company B is able to enjoy the benefits of the DTA, which provides for a reduced withholding tax rate on interest. For a list of DTAs that Singapore has signed with various DTA partners, you may refer to the IRAS website. What is a DTA? A DTA is an agreement between Singapore and another jurisdiction which serves to relieve double taxation of income earned in one jurisdiction by a resident of the other jurisdiction. The DTA also provides for a reduction or exemption of tax on certain types of income. Every DTA is different. Do you know that some articles in the DTAs may specify for a different withholding tax rate if the non-resident has a permanent establishment in Singapore? What is a permanent establishment? A permanent establishment, or PE, generally refers to a fixed place where a business is wholly or partly carried on. Here are some examples of what constitutes as a PE. There is usually a PE article in every DTA. You may refer to this article for more details on what constitutes as a PE. Going back to the earlier example, in order to determine the applicable DTA tax rate for its interest payment of $1,000 made to non-resident Company B, Singapore Company A may make use of the withholding tax calculator available on the IRAS website. In this example, the Singapore withholding tax rate applicable for interest payments made to non-resident companies is 15%. However, as there is a DTA between Singapore and the jurisdiction where Company B is a tax resident of, the DTA provides for a reduced withholding tax rate of 10% on interest. In other words, Singapore Company A would only need to withhold 10% of the interest payment amount, which works out to be $100, before remitting the net amount of $900 to non-resident Company B. Without the DTA in place, Singapore Company A would have to withhold the interest payment according to Singapore withholding tax rate, which works out to be $150. So how can non-resident Company B claim relief under the DTA? To claim the benefit of a reduced withholding tax rate under the DTA, non-resident Company B will have to prove that it is a tax resident of the DTA partner that Singapore has concluded the DTA with. The Certificate of Residence, or COR, is required to prove the tax residency of non-resident Company B. Singapore Company A will need to obtain the COR from non-resident Company B and submit it to the IRAS. Do take note that the COR must be certified by the Foreign Tax Authority of the non-resident company, and it has to be in English. In addition, it must state clearly that the non-resident company is a tax resident of the foreign jurisdiction for DTA purposes, as well as the years that COR is applicable for. One COR may be accepted for multiple periods if the periods are clearly stated in the COR. Otherwise, Singapore Company A will need to obtain the COR from non-resident Company B for each period where the double taxation relief was claimed. You may refer to the IRAS website for a specimen format of the COR showing the information required from the Foreign Tax Authority. So when does Singapore Company A need to submit the COR to the IRAS? The due date to submit the COR electronically is by 31st March of the following year if the claim is for a period in the current calendar year. If the claim is for a period relating to preceding calendar year, the due date to submit the COR is within 3 months from the date of submission of the Form IR37, which is the withholding tax form. In this example, Singapore Company A submits the Form IR37 on 1st April 20X1 in relation to the interest payment for the period between 1st March 20X1 and 31st March 20X1. Since the claim is for a period in the current calendar year, the due date for Company A to submit the COR for 20X1 is 31st March of the following year, which is by 31st March 20X2. What happens if the period of interest payment is between 1st January 20X0 and 31st December 20X0 and Company A only submits the Form IR37 on 30th January 20X1? Since the claim is for the period relating to the preceding calendar year, the due date to submit the COR is within 3 months from the date of submission of the Form IR37, which is 30th April 20X1. Let's recap. An Avoidance of Double Taxation Agreement, or DTA, is an agreement between Singapore and another jurisdiction which serves to relieve double taxation of income earned in one jurisdiction by a resident of the other jurisdiction. The DTA also provides for a reduction or exemption of tax on certain types of income. A permanent establishment, or PE, generally means a fixed place where a business is wholly or partly carried on. The Singapore payer is required to obtain the Certificate of Residence, or COR, from the non-resident company and submit it to the IRAS. The COR proves that the non-resident company is a tax resident of Singapore's DTA partner. The due date to submit the COR electronically to the IRAS is by 31st March of the following year if the claim is for a period in the current calendar year. If the claim is for a period relating to the preceding calendar year, the due date to submit the COR is within 3 months from the date of submission of the Form IR37. You may visit the IRAS website or contact us for more information.